The concept of financial independence, meaning to have enough savings that you don't need to work anymore, has become increasingly popular in recent years. This is in large part due to the FIRE movement, an acronym for Financial Independence, Retire Early. A growing group of Americans are calculating their FI numbers and figuring out exactly how long it will be until they can call it quits at work. Today we will tell you how much money you need to be financially free, or calculating how much money you need invested. 7. What is financial independence? Financial independence is when you have enough in your savings and investment accounts that the average annual return is equal to or greater than your living expenses. Once you've reached that point, you can conceivably live on that money indefinitely because you're not depleting your savings to cover your bills. For example, if you have $1 million saved and it's earning a 5% return each year, you could withdraw $50,000 a year and break even. Find the best stockbroker for you among these top picks. Whether you're looking for a special sign-up offer, outstanding customer support, $0 commissions, intuitive mobile apps, or more, you'll find a stockbroker to fit your trading needs. The challenge is determining what's truly a safe withdrawal rate. Fortunately, there have been multiple studies done to shed some light on this subject. 6. The Trinity Study and the 4% Rule. If you've read much about financial independence, you've probably come across the 4% rule. It claims that 4% is a safe withdrawal rate from accounts with a mix of stocks and bonds. That means once you've saved 25 times your annual expenses, you've presumably reached financial independence. The evidence behind this rule is the Trinity Study. 3 finance professors at Trinity University tested potential withdrawal rates for various ratios of stocks and bonds using market data from 1925 to 1995. Ultimately, they found that withdrawal rates between 3% and 4% were unlikely to deplete a person's retirement portfolio over a 30-year period. Now, there are some issues with how that study has been interpreted in the 4% rule. The study covered withdrawal periods of up to 30 years. If you want to retire at 50, 40, or even younger than that, you may be withdrawing from your retirement portfolio for well past 3 decades. It didn't find 4% was always a safe withdrawal rate. With the right mix of stocks and bonds, a 4% withdrawal rate over a 30-year period was successful between 95% and 98% of the time when adjusting for inflation. The 4% rule is a good starting point and it's simple to understand, but it's not necessarily safe. 5. The Early Retirement Now Study. The Early Retirement Now site has done a much more recent and detailed study on safe withdrawal rates. Like the Trinity Study, it analyzed withdrawal rates with several different ratios of stocks and bonds. It looked at longer withdrawal periods though, starting at 30 years and going up to 60 years to account for those who retire early. It also analyzed more withdrawal rates starting at 3% and going up to 5% in 0.25% increments. The Trinity Study, on the other hand, only used increments of 1%. 4. How much money do you need for financial independence? To be financially independent, a smart savings target is between 28.5 to 31 times your projected annual spending. That range allows you a withdrawal rate of about 3.25% to 3.5%, both of which are proven to be successful even over periods of longer than 50 years. Let's say you want to be able to spend $60,000 per year in your retirement. You'd aim to save anywhere from $1,710,000 and take a withdrawal rate of 3.51% to $1,860,000 and take a withdrawal rate of 3.23%. You can never be completely sure how long your savings will last. There's always the possibility of a worst-case scenario that takes out a huge chunk of your portfolio. But once you've reached the savings target above, you're in excellent shape if you decide to live off your nest egg. 3. The Spending Framework for Financial Independence. When it comes to figuring out how much you will need to be financially independent, we only need to know 2 things. 1. Your annual spending, and 2. How many years you need to spend for. Once we know these 2 things, we can estimate how much you will need to be financially free. For example, consider someone who wants to retire at 65 while spending $50,000 a year for 30 years. Note that $50,000 is what the middle-income U.S. household spends annually according to the 2019 Consumer Expenditure Survey. Assuming that this person has no other income in retirement, we can calculate their financial need using the 4% rule. The 4% rule assumes that you deplete your assets by 4% annually for 30 years. Taking $50,000 and dividing by 4%, or multiplying by 25, and you get $1.25 million. That's what they would need for financial independence at age 65 for 30 years. However, if we change our assumptions a bit, we can lower this number considerably. For example, if we assume that they will receive $1,500 a month, $18,000 a year, from Social Security, and $500 a month, $6,000 a year, doing freelance work they love, then they only need to cover the remaining $26,000 annually to be financially free. Using the 4% rule, this means they now only require $650,000 for financial independence instead of the $1.25 million in the original scenario. Their ability to generate income in retirement reduced their required financial assets considerably. But what about someone who isn't near retirement? If you wanted to be financially free starting at 35 instead of 65, then you would require an additional 3 decades worth of spending. All else equal, we can cautiously assume that if the time horizon is doubled, then the amount needed should double as well. So if you need $1.25 million for 30 years, you will need $2.5 million for 60 years. However, this would be very conservative since in the original scenario, $1.25 million for 30 years, the required rate of return was only 1.22%. If you use a financial calculator, you will find that the amount required for 60 years of financial independence when spending $50,000 a year while earning 1.22% is only $2.1 million. You can see that the amount required for financial independence may not be as large as you initially imagined, especially if you have other guaranteed sources of income. Of course, not everyone will feel financially independent when spending down their assets. As a result, they may only be comfortable if the income from their assets matches or exceeds their spending. If this sounds appealing to you, then the amount of assets you need to be financially independent is called your crossover point. 2. The crossover point. In the book Your Money or Your Life, Vicki Robin defines the crossover point as the point where your money investment incomes exceeds your monthly expenses. Robin refers to this as the crossover point because it is the point at which your investment income literally crosses over your expenses and allows you to reach financial independence. To find your crossover point, you only need 2 pieces of information. 1, your annual spending, and 2, your annual expected rate of return on your investments. Mathematically, using these 2 pieces of information, you can calculate your crossover point as crossover point equals annual spending over expected rate of return on your investments. Therefore, if you have an annual spending of $50,000 and you think your investments can provide you a 5% rate of return each year, then your crossover point would be $1 million. If you assumed an annual rate of return of 4%, your crossover point would be $1.25 million, which is identical to what the 4% rule would suggest for this level of spending. 1. Putting it all together. Now that we have examined a few ways of calculating financial independence, let's do a step-by-step walkthrough of how you can find how much you might need. Find your expected annual spending going forward. As a reminder, for middle income in the US, this is about $50,000 a year, and for the top 20% of income earners, this is $120,000 a year. I'm assuming you will be in this range. Reduce your spending by any guaranteed income you have coming in. If you can make $10,000 a year without issue, or you have Social Security income of $24,000 a year, then subtract this from your expected future annual spending. We will call this your annual excess spending. If you can earn 5% a year without issue, divide by 0.05. What you get by dividing the number in 2 by 3 is your crossover point and should be close to the amount of money you need to have invested for financial independence. I will do this below for 3 spending levels: $10,000, $50,000, and $100,000. At $10,000 in annual excess spending, you will need $200,000 to $500,000. At $50,000 in annual excess spending, you will need $1 million to $2.5 million. At $100,000 in annual excess spending, you will need $2 million to $5 million. While this exercise isn't perfect, the figures above should be in the ballpark for the level of spending mentioned. However, the exact figures aren't what's important here. It's the range of those figures that really speaks volumes. From the calculations above, we can conclude that the most important factor for reaching financial independence isn't your rate of return, but your spending. Technically, every person reading this post could be financially independent tomorrow if they lowered their spending enough and had no outstanding debt. Of course, this isn't realistic, but you get my point. Spending determines everything when it comes to reaching financial independence. Therefore, if you can find ways to be happy while spending less, you already own one of the most valuable assets in the world. Do let us know what financial position you are in. Thanks for watching.